Oh, what happened, Jack?
I don't know. Can you see that?
There we go.
Yep.
All right, good morning, everyone. We're going to give everybody just a few minutes to get logged in here. See participants starting to join. If you do want to download the slides, you can do so at that link on the screen, which is just at our website under the news tab. So you can have those slides in front of you. You're just joining us. We're just waiting a few more minutes to let people get a chance to get logged in. But if you want to download those slides for the presentation, they're going to be at our website under the news section or that link that's shown on your screen right now. Okay, well, it's just after 10, so I think we'll go ahead and get started this morning. So welcome, everyone, and thank you for attending our webinar today. We're very happy to have Adam and Dirk, both from Ansel Glink, with us today as well. And I'll introduce them in a minute here, but just again, I do want to say that the slides are available at that link there shown on your screen if you want to download those so that you can have those as we go through the presentation today. Oh, and now let's see. There we go. Sorry about that. So our panelists today are Adam, Dirk, and Jack. So Adam and Dirk are both from Ansel Glink, and we are very thankful for you both joining us today. Jack is from our own LNA here. So just to introduce myself as well, I'm Jen. I've been with LNA for about 10 years, working primarily with our audit clients in the government world. So happy to be here with you all today, just kind of moderating and working through some of the questions with the group. But as you can see, lots of experience on this call. So very happy to have our experts here today. So Adam, as you can see, has over 20 years of experience. Dirk is an equity partner at Ansel Glink. And then Jack has quite a bit of experience covering a multitude of topics as well. So really excited to have the three of you here today to touch base on these topics. So as you can see, we plan to update you on quite a few different things and just make sure that everybody has a good understanding of these topics on the agenda today. So I won't spend too much time here. I'll let the experts cover those pieces. but just what we plan on talking about today. And then, as I mentioned, as we go through, we will have Q&A. We'll try to tackle those questions kind of in real time as we go through. There may be some that'll have to wait to the end. It'll just kind of see how things go, but we will have dedicated time for each session for you guys to be able to submit some Q&A questions. And if you could please do that in that Q&A box below and not in the chat, it's just a little bit easier for us then to kind of wade through those Q&A questions. So just click on that button on the bottom of your screen, and we will do our best to answer all of your questions throughout the presentation. So with that said, I'm going to kick it off to Jack to get started here this morning.
All right, thank you, Jen. So when we talk about state and local taxation, the term that's always going to be brought up is this term of nexus. What is nexus? And the technical definition is nexus is defined as the minimal connection between a state and the entity that it wants to tax. Another way that I like to think of nexus is contact. Does a business have contact with another state? If so, or if they do have nexus, then a filing requirement arises. Traditionally, nexus may be triggered by having some employees, independent contractors, or property in any given jurisdiction. However, as we're going to see in the next couple of slides, that traditional term has drastically changed in recent months and years. So moving on here. Before we really get into sales tax nexus, I just wanted to make a quick distinction with respect to income tax versus sales tax. And from an income tax standpoint, the Interstate Income Tax Act of 1959, otherwise known as Public Law 86-272, this protects against the collection of income tax from some out-of-state retailers resulting from the sale of tangible personal property. Now, several conditions do need to be met for this. However, the simplified definition is if you have an out-of-state business making sales into, let's say, Illinois, if those sales are only tangible personal property and there are no other employees or property in Illinois, those sales are exempt from income tax. Those are not taxable. Now, a sales tax payer does not get to enjoy those benefits from the income tax side. From a sales tax standpoint, they are going to be liable for sales of the same nature that we're looking at for Public Law 86-272. So just wanted to point that out before we really get moving on here onto sales tax nexus. There's been a bunch of movement in this area within the last couple of years, and just want to provide a general overview on what's going on here with this. Types of sales tax nexus: physical presence. Of course, that's the standard traditional definition. There's also economic nexus. This is the very new concept that has just taken place. There's marketplace nexus, click-through and affiliate nexus. Those have really become a lot more outdated since the economic nexus ruling has occurred. So I think we're going to start seeing those phased out and becoming less relevant in the near future. So in June of 2018, South Dakota versus Wayfair was a sales tax case concerning physical presence nexus versus economic nexus. And now this went to the Supreme Court, and the court said that physical presence is not necessary for sales tax nexus. So this is really, very groundbreaking, because you suddenly may have companies who are out of state that don't have any physical location or employees who are now liable for sales tax. And this has never been the case for any other type of tax: income tax, gross receipts. Sales tax is very unique in this sense.
Jack, just to add to the degree of novelty this case introduced, it changed 50 years of precedent that tax attorneys all over the country had assumed would remain the case. In this case, the Supreme Court actually recognized the technological changes that our economy has experienced and really introduced a sea change in tax law.
Yeah. And I think the mentality behind the ruling was that the small states like South Dakota, for example, were missing out on a lot of sales tax revenue. You know, for example, let's say you have a high-end clothing company who has a location in California, and customers in California are going to the store and they're buying and they're paying that sales tax. And at the same time, people in South Dakota, well, that clothing store is not physically located in South Dakota, but you can still buy those clothes online. Before this ruling, South Dakota wasn't collecting, they weren't getting any of that sales tax revenue. But now after this, South Dakota, the court said, no, yeah, South Dakota, you're entitled to that additional sales tax money. So after this ruling in 2018, it set a precedent for many other states to follow, and the threshold, the economic nexus threshold that South Dakota laid out was $100,000 in annual sales or 200 in annual transactions in the state. If a business exceeded those thresholds, then you have economic nexus and a filing requirement arises. So the states do try to build in sort of a small business safe harbor where if you have 50,000, you're not liable for sales tax. So that is, I guess, a positive for some small businesses.
So to borrow your example about the fancy clothing store on Rodeo Drive,
yeah,
if they only send 10 transactions to South Dakota, they're not responsible for remitting sales tax to South Dakota. But if they end up shipping 210 dresses, then they've exceeded the transaction trigger and they would become liable for sending sales tax.
Correct. And that is true even if the revenue transaction threshold is below 100,000. So they could have 10,000 in sales, but 210 transactions, they trigger economic nexus in South Dakota. Yes. So what exactly does economic nexus mean? It's a very fancy term for saying that physical presence is not required to establish a filing requirement. You know, as we mentioned in 2018, the Wayfair decision said that the Supreme Court said that states are allowed to collect sales tax on sales without regard of physical presence. And so we had that example from Rodeo Drive. So I won't explain this example, but that shows the impact that this case has had all across the country. So what did other states do after this ruling? It set a precedent, so many states followed suit, and the states decided to get very creative. And what did they do? They just copied South Dakota pretty much exactly as they had it. So that I guess they didn't have to put too much thought into it. As we can see, our neighbors, Illinois, Indiana, Iowa, Wisconsin, they all have that $100,000 transaction or revenue threshold, same as the transactions. One thing I'll point is in Iowa does not even have a transaction threshold. And now this is not to say that if you have one transaction and you are under the 100,000 that you're liable for sales tax. That the transaction threshold is just not even there.
It's important to note that the dates that are on this table relate to the first set of amendments enacted by each state. Illinois enacted an amendment to its use tax in October of 2018. Jack will describe newer amendments that have occurred since then.
Mhm. Yeah. And then another thing I will mention is that not every single state is 100,000 and 200 transactions. For example, California is a $500,000 revenue threshold. So there is some variance to these states. The vast majority of them are pretty standard and consistent. But yes, and we do have this full chart. So I wonder if we could maybe send this out after the presentation for all 50 states. So why is this significant? You know, we're really trying to hammer home this idea that physical presence is not required. However, it does still exist. And I think sometimes with economic nexus, people think, oh, there's the threshold transaction, so physical presence doesn't matter anymore if I'm in a state. No, that still holds true. Economic nexus is just an additional sort of test on a company to see if they are required to file within the state. And yeah, I think and you know, I think it really also ties back to Public Law 86-272, where a filer could be protected from an income tax standpoint. That's no longer the case for sales tax with this new ruling. So now just looking a little bit deeper into, you know, the actual context of the case, the court specifically said that South Dakota satisfied the first prong of the test for whether a taxing structure substantially burdens interstate commerce. And so it implied that it probably did meet the other three, you know, prongs of the tests, but it did not provide a specific ruling concerning these. So I don't know, Adam, did you want to add anything other to this slide here?
Yeah, you know, certainly while Wayfair was a landmark decision and changed 50 years of precedent, it shouldn't be overread because it only gave an opinion, only opined on the first of these four tests. There has not been a follow-up case before the Supreme Court to determine whether these internet sales taxes that affect interstate exceed states' powers. This all arises from the U.S. Constitution. The U.S. Constitution says that states may not enact laws that substantially burden interstate commerce, and levying a sales tax on transactions that cross state lines very clearly affects interstate commerce. And the Supreme Court made a decision as a matter of law that when a business deliberately engages in economic activity in a state occurred, the Supreme Court declined to decide officially whether the South Dakota tax scheme met the other three tests on the screen here. In some informal commentary, it said it likely will pass those. And for that reason, I think there hasn't been a follow-up case, but there is that possibility that remains that someone could challenge whether an internet sales tax scheme discriminated between in-state retailers and out-of-state retailers. So if they charged a higher sales tax rate against out-of-state retailers versus in-state retailers, or the state didn't provide a simple enough means to help facilitate compliance. In Illinois, when they enacted the internet sales tax, they created these actors called marketplace facilitators, and they've created this master sales tax database. They've done everything they can to simplify and facilitate compliance with payment of sales tax. That's an important component of the state's sales tax scheme to comply with the tests described on this page. So it's not simply a matter of saying, we're going to start collecting it. The state had to put in place the machinery necessary to comply with these tests.
So continuing on looking deeper into this, as Adam said, the Supreme Court, they spoke very broadly about the rationale for determining this economic nexus statute. And it's worth mentioning, does this rationale apply any differently to income tax or to gross receipts tax? And if the court took a state income tax economic nexus case to this, if it went to the Supreme Court, who's to say that the Supreme Court wouldn't say that there's an economic nexus threshold for income tax? And that just will open a whole nother can of worms. But there's no reason to believe that that's not a very strong possibility in the near future.
The biggest difference between income tax and sales tax is this. With income tax, Congress has exercised its power over interstate commerce through the 1969 law that Jack described earlier. With sales tax, Congress has specifically failed to act in this area, even though it has the power to do so. And so for about 6 to 10 years, there's a bill that's been introduced in every Congress, Marketplace Fairness Act or some other name, designed to set up a nationwide internet sales tax scheme. And it's never passed Congress or even been sent to the president, obviously. Congress could supersede all these separate state laws if it wanted to. But because it hasn't, it created the opportunity for the Wayfair case and for now all the states to mimic South Dakota's taxing scheme.
Yeah. And so looking at this slide, I think the COVID implications really present an opportunity for Congress to perhaps move ahead with something like that. States are reeling from financial loss from COVID-19, and it's not unreasonable to believe that they're going to look to move more aggressively in multiple ways. First of which, they're going to aim to increase revenues by going after non-compliant businesses within their own jurisdiction in regard to sales tax collection. We could see an uptick in audits. And then another possibility would be, as we mentioned, states could challenge another economic nexus standard to income tax or a gross receipts tax. And, we really think that the opportunity is there with the economic impact that COVID has presented everybody. And it wouldn't surprise me to see either of these two options move forward. So looking ahead, we mentioned the government they do have exclusive authority to regulate interstate commerce. Various versions of the Main Street Fairness Act designed to place local businesses on a level playing field with internet businesses have been debated for several years with no action. This is exactly what happened with South Dakota and the Wayfair case. And there has been speculation within the community that the Wayfair decision is going to jumpstart the legislative process and possibly result in a nationwide sales tax program. So now moving on to some Illinois updates. In December of 2019, Pritzker signed the Senate Bill 119, which delayed until this January the requirement that remote sellers collect the local portion of the state's sales tax, which is destination sourced. And previously, remote sellers fell under Illinois' use tax statute. And since Chicago is the only Illinois locality with its own use tax, the compliance burdens were much lower. Adam, Dirk, anything you guys want to add there?
I'm answering a question in the chat or the Q&A, sorry.
Do you want me to have that answered live, Adam?
Sure. So if we feel a business has incorrectly reported sales tax during COVID restrictions, can we reach out to the business on the matter? It depends on what the nature of the error is. If we feel that the business is allocating, if the state has allocated the sales from that business to the wrong municipality and it's geographically being allocated incorrectly, then there's a process to go through with IDOR to correct the geographic allocations for that business. If the business is just simply underreporting their sales, then you have to ask IDOR to do an audit to confirm whether they're reporting all of their sales.
Right, this is outside of our jurisdiction as municipalities most of the time. Adam and I have encountered a couple of times where this was more frequent when big boxes were more active, where a big box moved from one community to another, but IDOR didn't move the tax revenue. So that was something that you wanted to track. But in terms of jurisdiction, what we can do is report, because the state has a stake in this, in getting correct taxes paid from the cash economy. And so, but it's their jurisdiction to enforce.
Then another thing I would mention there is businesses have an option to apply for a voluntary disclosure agreement. Now, municipalities can't really try to enforce that or move or push them to do that. That's all on the business themselves. And that's possible that, you know, if states are looking to be more aggressive, businesses themselves could look to initiate a voluntary disclosure with the state, which basically says, hey, we haven't been compliant or we've been incorrect for so long. We're going to go back and pay you this money, and then interest and penalties will get cut out of that.
IDOR will from time to time audit businesses and make sure that they're allocating their sales taxes correctly. A number of years ago, there was a number of high-profile sales tax audit cases involving Shanahan and other southwest suburbs that were acting as sales tax havens for companies that were located in Cook County. And they wanted to set up sales locations in a lower tax jurisdiction instead of in Cook County, because the difference in sales tax is somewhere between 2 or 3.5%. And so companies would set up fictional sales locations, or allegedly fictional sales tax locations. And IDOR stepped in and audited them, and the cases were brought up on appeal. And ultimately these cases ruled that these paper sales offices were not sufficient to recognize where the sales tax should be allocated to it. Should be paid.
So now looking at Illinois a little bit closer, you know, we have the 6.25% sales tax rate. 5% of that is the state portion, 1% local, 25.25% county portion. We also want to consider the home rule or non-home rule sales tax, as well as the transit and school sales taxes, which are all local taxes.
Yeah, the internet sales tax system that they've set up automatically collects all of those taxes. So a municipality that has a home rule sales tax doesn't have to do anything for the state to start collecting it from eligible internet retailers.
Mm-hmm. Looking at the collection cycle in Illinois, comptroller's office usually will issue a warrant to a municipality within 2 months of the original tax filing, 3 months after the transaction. Quick example, John will buy paint from a hardware store in January. On February 20th, the store files its January sales tax return. This payment includes the sales tax that John paid on the paint back in January. In March, Illinois is going to compile the information from the return into their system. It's edited for accuracy, and then the taxes divided to the amounts due to the state, municipality, county, whatever, or other local districts. And then finally, in April, the IDOR will authorize the warrants to be paid to the municipality, county, or other local taxing district.
I'm going to interrupt just to kind of tackle these two questions we have in the Q&A. This is probably a good point to do that. So the first one for you guys, does the Senate Bill 119 delay until January 1st, 2021 mean municipalities would see any type of increase in sales tax going forward, or would just the state of Illinois see that increase?
I can take that one.
Okay.
So as of January 1st, 2021, Illinois has started enforcing sales tax on remote retailers who meet those transaction thresholds that we went through earlier. Amazon had been doing it voluntarily for a long time, but now other businesses that have a lot of internet business in Illinois are mandated to start collecting and remitting sales tax to IDOR, and IDOR will be distributing it to local governments, to local municipalities. The big difference with internet sales versus in-state sales, the sales tax is allocated based on point of sale. With an internet sale that pays sales tax, that money is remitted to point of delivery. So if you have a homeowner who orders a couch from Wayfair, the sales tax for that couch goes to your municipality where the resident receives delivery of the couch instead of where they bought it from, because that's out of state naturally. So local governments should start seeing an increase in the amount of sales tax they receive from the state starting in April, which is, again, the first time you'll see a component that includes internet sales tax.
Particularly if you're a college town, because when you send things to your college student, it gets to the town where it's delivered, not where you bought it.
Jen, how are we doing on time? I've got a couple more of slides here before we get to the streaming tax. Should I maybe move a little faster on these next couple, you think?
Let's answer the one more. There's one more question that's
Okay.
remained to the current
Yeah.
topic. So let's answer that too.
Yeah. So can you discuss how you would anticipate use tax to change with this new law beginning January 2021?
So use tax is the tax pays. You know, there's a section on your Illinois income tax where you're supposed to voluntarily disclose when you've purchased goods out of state for use in Illinois, and you're supposed to voluntarily remit a use tax to the state. Very few people I know have ever done that, but nonetheless, there are some still transactions that are automatically captured. Use tax in Illinois is distributed primarily to the state and to Chicago, and the balance, which isn't earmarked for those two recipients, is distributed on a per capita basis to municipalities, a little bit like the motor fuel tax. And so local governments' income from the use tax is much, much than their share of the sales tax. So while use tax may go down, it should be more than made up for by your distribution of sales tax, I think.
Awesome. Thanks, Adam. And Jack, to answer your question, we're about halfway through, so I think we're doing okay
Yep.
on time. So just keep moving along.
Okay. So a route that some municipalities may want to consider is something called a statistical grouping report. And this is directly from the IDOR. They offer this. So local government may request this grouping report. And this is a report that lists 4 or more comparable businesses within that local government's jurisdiction that will provide the aggregate total of net revenue distributed to their local government. So one of the requirements is that the business they've got to be comparable to each other to make available reasonable statistics by grouping the contents of returns so that the information for any individual taxpayer is not disclosed. So who is eligible for these? County governments, municipal governments, pretty much any kind of local municipality will be eligible, with the exception of this one note here. Municipal governments that were not eligible to receive confidential information under a reciprocal agreement for exchange of confidential information prior to January 1st of 2015. So an example of this or reason one of these might be used would be for a request the local government's top 10 sales tax contributors for the last year, or the government may need to request the top 4 sales tax contributors for the last 12 months to secure insurance or something else of that nature.
If a government's going to sell a bond that's secured by sale, it would probably need to obtain to the top 10 sales tax contributors to disclose to the bond purchasers the diversity of the revenue source and how resilient it is and how reliable it is.
So that wraps up our economic nexus portion of the presentation. Not sure if we had any other questions out there.
Nope, it doesn't look like there were any other questions for that first section. If anyone out there does have any questions, feel free to still submit them via that Q&A box, and we'll make sure to get to them at the end of the presentation. It looks like we did just have one come in here, so I will read this one for you guys. Does the internet sales tax collection include local sales tax, not just the state sales tax or the 1% shared with sales tax? For instances, Town of Normal receives 1% shared sales tax and 2.5% local sales tax.
All of the sales taxes which are currently administered by IDOR will also continue to be administered by IDOR for internet transactions from retailers that meet the transaction thresholds to remit sales tax to Illinois. So if IDOR is collecting your home rule sales tax or a referendum approved non-home rule sales tax, then they will apply that to the internet transactions also.
Great, thanks, Adam. We do have another one that just came in as well. I'm not sure, Jack, if you know, or Adam, how a municipality could request that statistical group report from the state?
That is right through the IDOR on their website. There's an application for that. Just need some basic information. And we can send a link out afterwards to exactly where to get that.
Yeah, that's a great idea. We can definitely get a link out for that after the presentation. All right, so I think then that ends that first section, and we will turn things over then to Adam to keep moving forward with the streaming tax.
I'm going to jump in here and introduce Adam a little bit on this. So as you can see, Adam is the leader of our finance department at Ansel Link, and he also is wrestles with all the nuts and bolts of these issues, in addition to writing policy and reviewing, the budget ordinance and all the fun legal stuff. The nuts and bolts have become as difficult for clients to manage as anything, in particularly getting the dollars into your bank account. And that brings us to the streaming tax, where the general background is the idea that it's a tax on people who are engaged in purchasing streaming services. And that's not just Netflix, which led us to the name for this tax, the so-called Netflix tax, but also gaming and other entertainment. And it's exploded, as anybody who's watched any TV during the pandemic knows, from Disney Plus to now Paramount Plus, as they keep doing it, to all the other streaming networks. This has become the way people purchase this entertainment. And so that's great in concept that, so different states have imposed a streaming tax. Illinois has not. But in terms of the ability to impose a tax, as Adam will explain, it's largely up to the home rule communities. And the question becomes, why would you do that? And one of the drivers for those of you municipalities who are struggling with the concept of digital equity, this could be a possible way to help that. By digital equity, we mean we have students studying at home and we have businesses at home during the pandemic. But unfortunately, not every part of town is well served by the people who provide internet access, or at least high-speed internet access of the type that might be needed to deal with a homework assignment or to deal with business needs. And so there is a push. You can't pick up a municipal magazine of any kind and not see a push to try and bring digital equity, equal access across all of your community, both the rich and poor sections of town, if you will, to get onto the internet. And so we're trying to solve that structure problem. How do I get fiber to that part of town? How do I bring high-speed internet over here in a way that's cost effective? Even though I might not have a sufficient number of subscribers that the market would allow to say justifies bringing it. How do I close that financial gap? And the streaming tax is one way, as a municipality, if you consider putting on a new tax, which is never popular, but you're doing it to bring digital equity to your community as a way to do it, that's where this has now become an important part of the conversation. Yeah, some people do it just for revenue. That's why Chicago did it a while ago, and that's the case, as Adam will explain. But the fact of the matter is, it's now got currency, because if we're trying to solve digital equity, this could be a possible new funding source to get there. And one thing that Adam had said earlier about the vacuum at the federal level that was filled by the states and then by the local level about this taxation, even more so here. While some of the states have filled in the vacuum and other states have not, but local home rule municipalities have, it bears watching that Congress will want its share of this part of the streaming economy. And so I'm sure that vacuum will get filled at some point. But for now, I turn it over to Adam to talk about what exists in Illinois at the moment.
Thanks, Dirk. To pick up where Dirk left off, I think everyone has heard of the phrase cord cutters. Cord cutters are people who have cut off their subscriptions to conventional multi-channel video programming services, cable TV or satellite TV, but especially people who used to subscribe to cable TV and used to have to pay a franchise fee that would end up with the municipality, who have cut the cord and started receiving their video entertainment only through over-the-top services like Netflix or Hulu or Amazon Prime. Municipalities aren't collecting a franchise fee or a tax from those people because federal law prohibits municipalities from levying a tax on access to the internet. We can't levy a tax simply on the privilege of accessing the internet. That would that's prohibited by federal law. But in order to recapture some of the lost revenue that's gone away because there's fewer cable subscribers, some municipalities have looked to recapture that with this streaming tax, which is, again, not a tax on access to the internet. It's a tax on the privilege of receiving entertainment or amusements under the internet or from the internet. So Dirk referred to this as the Netflix tax. It is actually, under Illinois law, a form of the amusement tax. So you've probably heard a lot of different nicknames for it. Under a legal technical definition, it is a form of the amusement tax. And the amusement tax is authorized expressly under the municipal code in section 1142.5, where it says the corporate authorities of any municipality may license, tax, or regulate amusements. And so Dirk emphasized home rule communities have done this because there is express authority to tax amusements in the law. This tax may also be collected by non-home rule governments also. But the only two governments that have started doing it so far and have really implemented it are Chicago and Evanston, and those are home rule communities. So the precedent so far is only for home rule governments that have implemented this. So if you're considering adopting the streaming tax, the first thing you need to do is ask whether or not your community already has an amusement tax. If you do have an amusement tax, then you have to look through your definitions and see how to revise the existing definition of what constitutes an amusement to include the forms of streaming entertainment. If you don't have any amusement tax yet, then obviously you have to create a new tax framework and also create a new mechanism to start collecting the tax locally. So the first step in considering whether to adopt this is to start with the question of whether or not you're already collecting an amusement tax in the first place. For the purpose of collecting taxes or collecting an amusement tax on streaming entertainment, the definition of what how the definition of amusement needs to be amended is described here on this slide. Any video or audio or remotely accessed online games made available or delivered electronically to patrons on a rental or subscription basis. So conventionally, amusements have included movie theaters or live theater. It could include any form of in-person entertainment that you're viewing or participating in. This is obviously an expansion of that to include new forms of entertainment that are delivered over the internet. The challenge that arises because of this expansion is the collection of the tax. The conventional application of the amusement tax to local businesses that provide amusements means that you can go to them, knock on their door, and easily identify who's providing the amusement. They're all businesses located in your community. In this case, Netflix and Spotify and their peers aren't located where you are in most cases. There is, people might ask how much they're allowed to collect from the streaming tax. The statute, which we presented earlier, doesn't place a limit on the rate of tax you can collect for amusements. Chicago levies a 9% tax. Evanston collects a 5% tax. If you have your own amusement tax in your community, you may collect some other rate. The important thing to recognize is that there is no express statutory limit on this. The limit exists more as a political one to test what your residents will tolerate and to test what your local businesses will tolerate. Just to go through some of the different types of businesses that this tax would capture. We mentioned Netflix and Spotify before, Hulu, Amazon Prime. It also includes Pandora, Xbox Live Gold, any type of subscription game or gaming subscription to Xbox or PlayStation would be captured. It's broader than you might imagine at first instinct. So to distinguish the streaming tax from the sales tax, as we discussed earlier, the Illinois Department of Revenue has in place a mechanism to enforce and collect all sales taxes in Illinois. All the sales taxes are remitted by the retailers directly to the Illinois Department of Revenue. And according to the process Jack described, it goes through a number of funds and eventually gets remitted back to the local government. In this case, the state is not involved at all. The amusement tax has to be collected and enforced by each municipality that levies it. That puts a much bigger burden on your local finance department to discover who has to pay the tax and to enforce it as well.
Hey, Adam, I had a quick question.
Yeah,
What if I'm streaming sports through ESPN or something like that? Does that fall under this category as well?
ESPN Plus would fall under that category as well.
Okay.
Yes. Any over-the-top service could represent a form of amusement delivered over the internet. So we have a series of questions, and these are all good ones. So why don't we spend a few minutes answering these questions, because we really want to answer the things that you need to know before we move on.
Yeah, do you want me
The
to read?
question says, yeah, go ahead.
Okay. So the first question we have is, do you have recommendations for ways to collect this tax?
Yeah, the first step is to identify who's responsible for paying it and to find where to send notice that the tax is going to be implemented. We have started collecting the names and addresses of the companies that are in the business of providing these over-the-top entertainment services and gaming subscriptions. We have worked with IML to identify the parties who are paying the taxes in Evanston and paying the taxes in Chicago. And we're putting together a database of those taxpayers and their addresses so we can send notices for those clients of ours who start implementing this tax. But the first step is to create that database and send notice to the companies that are in the business of providing the amusement. The taxpayer in these cases is the company providing the amusement. They are allowed to reimburse themselves for the tax from their customers, and they all do. But this is a form of occupation tax that's expressly authorized by law. And so the tax is applied in most cases on the business engaged in the business of providing an amusement. Some communities might instead say they want to levy the tax on the subscriber for the privilege of receiving the amusement over the internet. The same challenges exist though, because you still have to identify the business who is charging the customer so that they will start collecting it for you. So regardless of whether you style this as an occupation tax or a privilege tax, we still have to identify the businesses engaged in providing the amusement so they'll start collecting it and remitting it to you. You want to move on to the next question?
Yeah, so the next one is obviously very with the times as we see more of these things coming out. So would you be able to include the Peloton or the Mirror or any of those really physical fitness subscription or membership fees as part of this streaming tax?
I think the answer is likely yes. There was a landmark case involving Bally's or the predecessor of Bally's and the city of Chicago when they levied an amusement tax on gym club memberships. And there were some limitations on Chicago's authority recognized by that case because of the breadth of services that health clubs provide. And not all of those services can be characterized as amusements because they're different types of services. But so long as we carefully define what is an amusement, I think it can be defined to include the types of entertainment provided by Peloton or Mirror provided over the internet.
Yeah, I was going to mention the Bally's case myself, Adam, in answer to that question. I'm a little less optimistic that they would be seen as entertainment or an amusement. I think they will push the whole health care angle that while they are a subscription, which would make them subject to the tax, it seems, that they're a subscription for health services. And so they would, I think they would argue that they're something other than an amusement, but close call.
Yeah, it would be a test case for sure.
Yeah, some of those are very fairly new too, so. The next two really are the same. I think you've answered this, but just to clarify again for everyone, who pays the tax, the provider or the household?
Yeah, it depends on how you style the tax. Because it's because it's an occupation tax expressly recognized by the law, you can levy the tax on the provider of the service, and they would be paying it based on their gross receipts from transactions located in your municipality. Or you can style the tax as a tax on the customer for having the privilege of receiving the amusement over the internet. So you can levy it either way. Mechanically, though, you have to figure out a way to get the provider to collect the tax for you, or to pay you the tax.
Right.
Under each scenario, the provider is going to reimburse themselves for the tax and collect it from the customers in your community. So regardless of who's paying it, the mechanical challenges of identifying the provider and getting them to collect it for you are similar.
All right, this next one specifically looks like it's discussing the Chicago case. So there was chatter that the industry, Netflix, et cetera, was going to challenge other local governments other than Chicago adopting a streaming tax, as I believe that the previous Chicago case didn't address all the legality issues of whether this tax could be adopted. Has that happened with Evanston or anyone else yet?
I'm not aware of any other challenges to the application of the amusement tax to internet forms of entertainment. The challenge to the Chicago tax was pretty simple. It challenged it as an internet access tax that's federal law, and the court found that it was not. It challenged the classifications created by the Chicago tax, and it found that they were rational and satisfied the standards required for that test. The people who challenged the Chicago tax did so fairly comprehensively, and the court dismissed all of those challenges and upheld the Chicago's application of the amusement tax to these forms of entertainment. Because Chicago's home rule, that case really serves as a strong precedent for home rule municipalities. So there could be a challenge to non-home rule governments doing this that would be unique from the Chicago case. But again, there are no non-home rule governments that I'm familiar with that have fully implemented this, and I haven't seen any court challenges against them either. So hopefully that answers that question.
Yeah, and then kind of skipping down just to the last one, since you already did start talking about this just now. So the question was, is the tax actually able to be enacted by a non-home rule form of government?
There's certainly an argument for that it can, because I mentioned earlier, the streaming tax is a form of the amusement tax, and the amusement is recognized by Section 1142(5) of the Municipal Code. And for those of you who are familiar with the distinction between home rule and non-home rule governments, a non-home rule government can only do or exercise that power expressly recognized in the law. In this case, there is the power explicitly granted to government, to municipalities, to levy a tax on amusements. And so we would argue that this is an implementation of that authority. But there is no test case, back that up yet, like there is in the Chicago case. The Chicago case, again, was a test of a home rule exercise of this power. But I think there's a very strong argument that you could.
Okay, and then we also have, I'm not sure how well you'll be able to answer this one, but what is the likely legal exposure for municipalities? Should we expect to get sued by the likes of any of these providers?
It's, I think the major providers are all familiar with the Chicago test case. And I think that you can do yourself a favor in the course of implementing this. When you send notice to these forms of amusement providers, you can send them a copy of the Chicago case to help inform them and educate them about the state of the law in Illinois. You can be proactive in deterring challenges to the tax by showing that it's been tested and that it's been upheld upon review. So the potential exposure is that a court could find after the fact that you didn't have authority to collect the tax in the first place and require you to disgorge all the taxes you collected. Anyone who's been around in municipal government since the late 90s might remember a case called the Primeco litigation, where municipalities were to disgorge the infrastructure maintenance fee that they collected from cellular subscriptions, because the court found that cellular subscriptions don't use the rights of way to provide telecommunication services. It's provided in the air. And so municipalities had to give back the infrastructure maintenance fee they collected from all of these cellular subscriptions. That's the worst case scenario. But again, we have that precedent from the Chicago case showing that there is authority to collect this. But that's the worst case scenario, is that you'd have to disgorge all the taxes you collected.
I think that a more likely scenario, as I said, there are a number of states that regulate this at the state level and do the tax collection that way, is that they'll do what others ahead of them, AT&T and Comcast and others do, which is run down to Springfield and pass new legislation that will create a more favorable environment where the state controls it. And then we get, as municipalities, we get a taste, but we sort of get pushed to the side, as we've seen happen other places. Now, I don't know that that's on the agenda of the Black Caucus and the Latin Caucus, who are sort of setting the agenda presently down in Springfield. But I think in due course, as the legislature gets back to working more routinely than they did during the pandemic, that's where I think you're more likely to see something change. And certainly that'll go into effect in the future. So I don't think it's going to be that whipsaw where we have to disgorge the money. But my anticipation is that they'll run down to Springfield and get something a little more favorable to them in terms of rate that makes them, keeps them competitive for the people they're trying to sell their services to.
Yeah, what Dirk is describing is very likely if there's a groundswell of communities that start adopting this tax. There are a number of examples of the state offering a trade-off between taking on the administration of this tax and making it easier to collect in exchange for keeping a share of it and remitting a little bit less to the municipalities. Going back to that Primeco example I said before, they substituted the infrastructure maintenance fee that was collected by each separate community with a statewide municipal telecommunications tax. And that simplified municipal telecommunications tax is now collected by the state and remitted to you. But there's a cap on it, and you have less discretion on how high it can go. So if there's a number of communities that can start adding this tax, I can certainly see the industry going to Springfield and trying to simplify their compliance by creating one flat rate throughout the state, and reducing the burden of identifying all the different governments they have to send checks to. So that is a possibility.
Okay, so the next question is, how long has this tax been in Illinois?
Well, the statute that Adam's talked about, it's been on the books for quite some time. The idea that these streaming services are an amusement, the streaming services themselves haven't been around that long. The Chicago case was 2018, Adam, as I'm trying to remember. So they started looking at that in 26, for that to percolate up to be a case. I think that people started looking at these services in 2015. The amusement tax itself, that authority's been around a long time, but that these are a unique form of amusement worthy of taxing is a more recent advent, and now particularly with the cable cutters, as Adam described them, and moving to suites of subscriptions instead of just general cable. That's where this is finding a lot more traction.
Yeah, Illinois, Chicago first issued a tax opinion in 2015, finding that their definition of amusements included these sort of internet amusements. In 2019, the appellate court affirmed the trial court's decision upholding the tax levied by Chicago. So it's really only been around for about 5 years, 5.5 years, and it's only been affirmed by the appellate court now for about 16 months.
All right, the next question was, can you give an example of who is a provider of this service? And I know we've had quite a few of those with the Netflix and Spotify and Hulu and any of those streaming type services a few slides back. Yep. If that helps with that question.
Yeah.
And I know we're a few minutes over, but we do just have one more question. So may have missed it, but is there a list of contacts for any of the content providers that could be shared with the group?
Yeah, like I said, we've been working with IML to collect those names and addresses. IML might end up making those names publicly available. I know that they have been promoting this tax and sending out information about it. I haven't talked to Dirk about whether we're going to start giving that information out for free also, but certainly those of our clients that implement the tax will get our assistance in collecting it as well.
Yeah, that's a conversation that we have to have with Brad as well. So, you know, because they've been laboring as well. So we'll have to figure that out. But yeah.
That's Brad Cole for everyone who's not in IML speak.
I think this last question is just clarifying if Nintendo would be one of those as well, which I think similar to what you said with the streaming for Xbox and PlayStation would probably fall under that in some aspect.
Yeah, one of the
Yep,
challenges,
for
one of the challenges for us is keeping up with all the services that are out there. So
Right, Peacock's new, Paramount, Paramount Plus. I keep doing this because last night Stephen Colbert had John Oliver on, which is a high time. But they kept promoting the Paramount Plus, and they kept doing that every time they said it. So that, you know, but that's a brand new streaming service that is coming with all of its backgrounds. You saw it advertised a zillion times on the Super Bowl. So that, you know, like Adam said, it's hard to keep up.
I would imagine YouTube TV would also fall under this
yep,
umbrella.
yeah.
Yeah, so don't forget to subscribe and like, pound that button
Yeah.
to the Louderbox channel right there.
Perfect. So I guess, Adam, anything to wrap up this section? I know, like I said, we're a few minutes over, so thank you everyone for kind of bearing with us.
Yeah, the only thing I'd wrap up with is if you're interested in engaging in the collection of the streaming tax, talk to your peers who've done it, learn from their experiences, and take your time in developing a collection framework to help make yourself successful. Doing this quickly does not necessarily translate to success. You have to make sure you build in an adequate collection framework and communicate clearly with the providers to increase your likelihood that you'll collect what you deserve.
Perfect. Well, I want to thank everyone for joining us today, and especially thank Jack, Dirk, and Adam for providing all of this helpful information for everybody on this webinar. So thank the three of you. Just for all of our clients out there joining us today, we do have another session coming in March. We're working on those topics and we'll get that information out to you. Our goal really this year, as we mentioned in that invitation, is to have a different topic for our clients every month this year. And I'm really hoping towards the end of this year, we'll be able to do some of these in person, of course. But until then, we're happy that you were able to join us on the webinar today. So thank you, everyone, and have a wonderful day.
Thank you.